How much cash flow should my rental properties actually make me? What if I told you that most landlords have absolutely no idea whether their rental properties are actually making them money or losing it? And the ones who think they know, well, they are often using the wrong numbers entirely. Today we are breaking down exactly how much cash flow your rental property should realistically be generating. And I am giving you 5 real case studies that will completely change how you look at your portfolio. Before we dive in, if you find value in this content, please hit that like button right now, subscribe to this channel, and ring the bell so you never miss another video like this one. Everything we discussed today goes deeper in my free ebook and free course, both available for download at the link in the description below, so make sure you grab those. Hello, I'm Nellius. Now let us get into it, because what you are about to hear might just save your entire investment strategy. So here is the thing that nobody wants to admit in the real estate world. Cash flow is not just one number. It is a living, breathing reflection of every single decision you make as a property owner. The rent you charge, the expenses you ignore, the vacancies you did not plan for, all of it feeds into this one critical figure that determines whether your rental business is thriving or quietly bleeding you dry. And yet so many investors just look at their bank account at the end of the month and think, okay, money came in, so I must be doing fine. That is one of the most dangerous assumptions you can make. Let me give you the foundation before we get into the case studies. Cash flow in its simplest form is what remains after every single expense has been paid. We are talking mortgage payments, property taxes, insurance, property management fees. If you use a manager, maintenance and repairs, vacancy allowance, capital expenditure reserves, and any utilities you as the landlord are responsible for covering. When you subtract all of that from your gross rental income, what you have left is your actual cash flow. And that number tells you the truth about your investment. Now the question everyone wants answered is, how much cash flow should a rental property actually produce? The honest answer is that it depends on several variables, including your market, your property type, your financing structure, and your investment goals. But there are benchmarks that serious investors use. Many experienced real estate investors aim for a minimum of $200 to $300 per unit per month in net cash flow. Some investors operating in higher priced markets are satisfied with $100 to $150 per door. Others working in lower cost markets with high rent to price ratios can achieve $500 or more per unit monthly. The key is understanding your specific situation and measuring it properly against the right standard. This is where my effective property management course becomes absolutely essential. Inside that course, we walk through exactly how to calculate your true numbers, how to build a cash flow model that accounts for every variable, and how to make smarter acquisition decisions based on real data rather than optimistic projections. You can become a member by clicking the link in the description to learn more. Download your free ebook, Manage Properties Like a Pro. Now let us get into the case studies that will bring all of this to life. Case study number 1. A single family home in a mid-sized Midwestern city. Purchase price was $140,000 with a conventional mortgage at a 30-year fixed rate. Monthly rent collected is $1,400. On the surface, that sounds like a solid return. But when you dig into the actual expenses, the picture shifts considerably. Monthly mortgage payment comes to approximately $710. Property taxes and insurance together add another $240 per month. A proper vacancy allowance of 8% of gross rents adds about $112 per month to the cost side. Maintenance reserve at 10% adds another $140. After all expenses are totaled, the actual monthly cash flow lands at approximately $198. Not bad for a starter property, but not exceptional either. The lesson here is that what looks like a great deal at first glance is actually a moderate performer once you apply realistic expense assumptions. Case study number 2. A small multi-family duplex in a southeastern coastal market. Purchase price was $220,000. Each unit rents for $900 per month, so gross monthly income is $1,800. The mortgage payment on this property is around $1,050 per month. Property taxes and insurance run $320 monthly combined. The investor manages this property themselves, so there is no management fee, but we still need to account for the time value and a maintenance reserve. Vacancy allowance at 7% is about $126. Maintenance and capital expenditure reserves combined are set at $250 per month. Total monthly cash flow after all deductions is approximately $54. That is right, just $54 per month on a $220,000 investment. This is actually a very common situation in coastal or high appreciation markets, where the cash flow is thin, but investors are betting on long-term appreciation to build wealth. It works for some strategies, but you need to know this going in, not after the fact. Case study number 3. A 6-unit apartment building in a Rust Belt city with strong rental demand. Total purchase price was $380,000. Average rent per unit is $650, giving a gross monthly income of $3,900. The commercial style financing results in a monthly mortgage payment of $1,980. Property taxes and insurance together are $460 per month. The owner uses a professional property manager who charges 8% of collected rents, which is $312 per month. Vacancy allowance at 8% is $312. Maintenance and capital expenditure reserves for a building this size are set at $400 per month. Monthly cash flow after all of these deductions is approximately $436, or roughly $72 per unit per door. This illustrates a critical point. Larger properties do not automatically mean better cash flow per unit. The efficiency of the deal depends entirely on how well the numbers stack up at acquisition and how tightly the property is managed afterward. Case study number 4. A short-term rental property converted from a long-term rental in a vacation market. The property was purchased for $290,000 and previously generated $1,100 per month as a traditional rental. After being repositioned as a short-term rental, it now averages $3,200 per month in gross revenue when accounting for seasonal fluctuations. However, the expenses are dramatically higher. The mortgage sits at $1,410 per month. Short-term rental platform fees and cleaning costs combined average $650 per month. Property management for a short-term rental comes in at 20%, which is $640 per month. Insurance for short-term rentals is substantially higher, adding an extra $90 per month above what a standard landlord policy would cost. Supplies, restocking, and minor maintenance run $200 per month on average. Vacancy and seasonality adjustments reduce gross revenue by about 15%, effectively reducing net operating income considerably. After everything is calculated, monthly cash flow averages around $360. Higher than the long-term rental, yes, but you are also taking on significantly more operational complexity, higher risk, and more time. The cash flow per hour of effort may actually be lower than a boring long-term rental sitting quietly in a mid-sized city. Case study number 5. A house hack scenario where the investor lives in one unit of a triplex and rents out the other 2. Purchase price was $265,000, financed with an owner-occupied loan at a lower interest rate because the buyer declared primary residence. Monthly mortgage payment is $1,290. Each rental unit brings in $950, so total rental income is $1,900 per month. Property taxes and insurance are $310 combined. Since the owner lives on site, there is no property management fee. Maintenance reserve across the full property is set at $250 per month. After accounting for all expenses, the owner effectively generates a monthly cash flow of approximately $150 and covers the majority of their own housing costs. The real wealth building here is not just a cash flow number on paper. It is the effective elimination of personal housing expense, which might have otherwise been $1,200 per month in rent. When you factor that in, this investor is effectively capturing over $1,300 per month in total financial benefit, making this one of the most powerful entry-level strategies available today. Now, what do these 5 case studies tell us when we look at them together? First, cash flow varies enormously based on market, strategy, and financing structure. Second, the number you see before expenses means absolutely nothing. The number you need to obsess over is what hits your account after every single cost has been deducted. Third, there is no universally right answer for how much cash flow is enough, but there is definitely a wrong answer, and that wrong answer is not knowing your number at all. Most investors fail not because they chose bad markets or bad properties. They fail because they never built the discipline to track their actual numbers, adjust their assumptions, and make data-driven decisions. Emotion drives a lot of real estate purchases. Fear of missing out, excitement about a hot neighborhood, or attachment to a specific property type. What separates consistently profitable investors from the ones who sell off their portfolios in frustration 5 years later is the ruthless application of financial discipline from day one. And this is exactly why I want to point you again to my effective property management course. This is not a basic overview of real estate investing. This is a comprehensive system for managing your properties, your numbers, your tenants, and your time in a way that actually produces sustainable long-term wealth. Becoming a member is simple. Just click the link in the description to learn more and take that next step in building a portfolio you can be proud of. Also, do not forget to grab your free ebook and free course by downloading them at the link in the description below. These resources are packed with tools, frameworks, and strategies that will help you evaluate deals faster, manage property smarter, and build wealth with intention rather than guesswork. So, let me wrap this up with the honest truth that most YouTube channels will not tell you. There is no magic number for cash flow that works for every investor in every market at every stage of their journey. What matters is that you define your target based on your goals, that you underwrite every deal using conservative and realistic assumptions, that you track your actual performance against your projections month after month, and that you never ever confuse gross income with profit. Your rental properties should be building you real financial freedom, not just the appearance of it. And the difference between those two outcomes almost always comes down to how honestly and accurately you measure your cash flow from the very beginning. Take the case studies we covered today, apply those frameworks to your own portfolio, and then ask yourself the most important question in real estate investing. Am I actually making money, or am I just collecting rent and hoping for the best? The answer to that question, once you know it honestly, will change everything about how you invest going forward. I'll see you in the next video.